Hi everyone, thanks for joining today's Market Color call. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend any particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any questions after listening today, please feel free to reach out to Jordi directly or our marketing team. Weiss would love to hear from you. This replay will also be available on the website or on the Weiss YouTube channel later this afternoon. With that, Jordi, the floor is yours.
Thanks, Leah, and hi, everyone. It's been a little while since I did an update. It's really been a function of just kind of waiting for something new to go on. So what I'm going to do today is kind of take you through some of the old, a lot of it related to MMT, but there are some trends that are happening, and now that we're through the earnings period for Q2, and we're now 5 months from really I would say the beginning of the fears in March and the reality of stay at home, I think there's some secular trends that are starting to show up, which I think are important for people to think about. And so hopefully when I go through this, we'll be showing you some opportunities, but also some real-time factor shifts that I see happening at the moment that I think are actionable and things that are likely to last into the end of the year. So first thing, we're now at a point where we really do have to continually focus on the historic nature of this. And I just wanted to start off with the simple year-over-year chart of M2 in the US. This has played out through a lot of this, and as I go through the beginning part, we've gotten more economic data. This is no longer just 1 month. This is really related to things that I think people have to pay attention to, particularly with regards to the election. And I think the election is something to think about when you look at the first couple charts here. This is real personal income year over year. We've now had enough time in terms of the last 3 months to think about the historic situation of income actually growing during a recession, how that has never happened before, and really thinking about the implications as we think about a world of MMT. And I'm going to repeat a line that I say to everyone in the office on a fairly repeated basis and to a lot of our investors, which is at some point you have to think about the impact that the economy had and how much money we printed, and rather than try to forecast whether things are going to break down, there is some number that honestly is too much with regards to what we did, and there's implications for that. And so hopefully as we go through these charts, there'll be something in there that leads to some thought process. This is what I mean when you're thinking about a presidential election. You'll hear one side talk about the fact that the economy and job losses will drive it, the handling of the crisis, but the reality is this is the disconnect, which is really never happened before. The white line there is year-over-year GDP. The orange line, again, is personal real income. So real income is at the highs on a year-over-year basis, dating back to really the early 80s, while the economy has fallen off. And obviously, you're going to start seeing a massive V in the economy, as we've seen in the real-time data. Year over year will keep going higher, but that is going to have implications in the debate over the next election. In terms of an update on something that I mentioned, which I think is the most important theme happening in the market, is the sustainability of the durable part of personal expenditures. Again, people have focused on the vacation side, the restaurant side, in terms of spending going down. They've been looking at credit card data to look for weaknesses, and the reality is we've seen no weakness on the durable side of the equation with regards to homes and autos, which again alone count for more than 50% of the economy and expenditures. So this is the personal, the PCE durable side of the equation, just ripping through the highs. And you can see back after the 07, 08, 09 crisis, it took us a long time, all the way back into 2014, to get through the highs. This took a couple months. It's an important change, and I do not think that this is a temporary shift for a lot of reasons, which I'll try to talk more about. This is the new orders component of the service side. So the durables have been leading, which has led to the manufacturing. The new orders on the services reached an all-time high dating back to 2001 that just came out this month. You also have the backup for what is driving that durable side. So this is the motors. So motor vehicles have gone through the highs. Again, I mentioned this on the first webinar I did, saying that the Chinese data was leading and they had already accomplished this. Now the US has basically accomplished it, not on the SARS number, but when you add in the auto parts, when you add in used cars, you're getting to, you're taking the overall dollars spent on autos back through the highs. And it took us all the way to 2012, 2013 to accomplish that feat back in after 2009. This is the furnishings and durable household side. So think of furniture, appliances, everything along those lines. That's confirming the auto or the durable side, and in particular the housing side, which is a major story that continues to go. When you look at the vacation side, I created this and I showed this last time. This is basically the vacation side. This combines amusement parks, casinos, airfare, hotels and motels. So the spending collapsed. It's still down, and I think this is going to stay down relative to where it was for some time. View that as the auto side and the housing side back in 08, 09. The difference is this time recreational goods, another form of durables, another thing over experience is going. We're just buying a lot of stuff right now, which is a different behavioral shift from what was going on before. And that's where you're going to have to make the decision on whether this is something temporary or whether this group, which to some degrees was value, is the next growers coming out of this. And I think that's the debate that the market is starting to go through, is whether this durable thing is more than just a temporary thing. This is showing you the PCE durable versus service side. So services remain lower. Everything ranging from barbershop, legal services, all of this stuff is still on the lower end, while the durable stuff continues to go higher. As you move it in a little further, this is showing the ratio of the durables to the service. So again, when you see these types of moves, they're historic in nature, they're behavioral shifts. Once it was 1 month, but as people have now gone outside and we've had more months of this, you haven't seen the shift back. Now this data is through June, but it is important. This is the relationship of the durables component to the S&P. So regardless of whether you're looking at the PMIs to justify the S&P bounce, earnings revisions, which are up at near the highs, or the durable side, which historically has a huge correlation with the S&P, you can see the white line here is already well through the highs, and now the S&P is at new all-time highs today or just below. So we've accomplished both those feats in terms of the durable driving it. When you look at the relationship between autos and housing, this is the SAR number for autos, which is the white line. The orange line is housing starts. We are seeing tremendous demand for housing starts. We have low inventories. I think as I go through some of these charts, I'm going to try to make the argument for everyone that they should be spending a lot of time on the housing market and what the implications are, particularly in the concept of urban flight, which continues to happen. This is one of the structural secular changes that I think has implications for the growth over value trade in a variety of different ways. And I think for the rest of the year, given the fact that most people will continue to stay at home until we get into 2021, people should be focused a lot on what happens during housing and where structurally millennials are versus baby boomers, as during the last 2 months, one of the big changes in the world is that there's more millennials in the United States than baby boomers, and the home ownership rate for millennials is way below where it had been for Gen Xers and for baby boomers, about 8% below. So this is an important shift in dynamic with the combined with the urban flight side and the ability to work from home. This is the National Association of the Home Builders Index, which got up to the highest level since 2006, confirming what we've seen in the PCE spending side. This is household formation. So this really gets into the concept of what is happening with the millennials. One of the big stories has been the fact that the millennials were renting more, they were staying with their parents more, but as they're getting into the late 30s or the mid 30s and having children, the concept of wanting a house is there. When you combine it with the fact that 30-year mortgage rates had gone down to 3%, the analysis I use is a town I grew up in close in New Jersey, which has houses about 400 to 500,000. Your monthly mortgage with a 30-year fix would be somewhere in the $1,300 to $1,500 range, and the average studio apartment in Manhattan right now is about $3,200. So you have a very combustible situation which has been created during this, and as the flight continues, I think people need to think about it. This has happened with the last 4 months of occupied housing units in terms of the growth. So you can see that, again, on a 4-month basis going back, this is the fastest that we've seen people going into houses. This will combine both renting and purchasing. Even on the renting side, it's cheaper. This gets into payrolls for people on the building materials and gardening side, exploding through the highs. So you're not only seeing it in terms of the actual data related to housing, but you're seeing it on the hiring side. And then obviously on the input side, this is lumber prices. This is the last 90 days up over 150%. Even today, it's up another $15. So you are having lumber shortages, and this has come out of nowhere. This is the home builders ETF, which has obviously gone straight up. So if you look at this, we made the low on it for the last 7 years, and then we made the high on it for the last 7 years. When you see those types of movements, it's something that I think is important to spend a good amount of time on. This is the used vehicle prices for the last 3 months. This is the 3-month rate of change. So used vehicle prices are continuing to go higher, showing the strength in the auto market. In terms of the last thing, I did spend a lot of time thinking that if you're going to print this much money and if you're going to have rates at low levels and you're going to be the dominant printer in the world, that I think part of the issue that comes out of this is where the supply chain issues are going to be, how structurally is a country set up for what they're doing, which is printing money. And I think in the US, there's a huge structural shift between the China-US divorce, which is having impacts on the supply chain, which I think exposes us. At the same time, you've had the money printing, which is going to create the deficit side, and we're still doing more. This is what's gone on with the dollar. So there's been a lot of op-eds and debate over whether the dollar is crashing. Crash is just a word that I think is meant to scare people. The reality is this is the largest 100-day fall in the dollar in terms of rate of change. It's now at minus 8.6% since 2010. The lowest we've seen is down around minus 11. So we've already had a significant move down in the dollar. That will have impacts for the earnings here. It will have impacts for the market, but also has impacts for some of the reflation trades. This has happened without some of the Asian EM and the Chinese yuan. So what I wanted to highlight is most of the damage that's been done so far in the dollar down here has been the European market. So we still have the Chinese yuan and we still have the EM currencies not having moved down or strengthened versus the dollar. So the dollar's actually been hanging in there so far versus them. I think that's where the next phase would be to look for. I think EM is a laggard in here, and as I go through some of these charts, I'll make an argument why. This is the rate differential that I think is having an impact in particular for now the yuan. This is the rate differential or the 10-year rates for both China and the US. So you can see that US rates have stayed sideways while Chinese rates have gone up about 40-50 basis points and then are equivalent to where US rates were not that long ago last week. So that rate differential is starting to have an impact and starting to, I think, drive not only the currency weaker, but probably start to pick up the US yield situation. Now, this is just the differential. So the white line is the differential between Chinese 10-year rates and US 10-year rates. Obviously, Chinese rates are going higher relative to US rates. And this is the ADXY, which is the Asian dollar index. So I think the Asian dollar index has also lagged. I think you're going to see some strength there versus the dollar. So far, it's only been the European currencies. You have a lot of room for more weakness in the dollar, in my opinion, in the coming months. And so this is it just versus the ADXY again. Meaning the dollar index versus. So that's where I would say you still have some room left in the dollar. Now, one of the other important themes, which I've highlighted every time I've been on here doing these webinars since COVID started, is the sentiment. The AAII net bull bear, we're at minus 24 last week, which is still low. This is the 10-week moving average. We've now done 21 weeks in a row with more bears than bulls, and I'm going to show you why that makes sense based on the way people are talking. It's hard to imagine stocks at all-time highs, revisions going up, the economy rallying in terms of PMIs and new orders, and still have sentiment negative, but that's where the opportunity lies. So the 10-week average is still near all-time lows. This is it versus the PMI going back over time, just to show how unique it is to have the economy strong and not have sentiment changing dramatically on this. This is it versus revision. So this is the revisions index. This is the 5-week average versus, again, this is the 10-week average. So you're just not seeing what you normally see when you're getting this kind of positive news on securities. And the real reason is because the percentage of stocks closing above the 200-day moving average has not got to 50% yet. So normally when you have this going on, there's a breadth to this. This has been dominated by, obviously, the big five in tech. It's been more of a situation where the same areas that were working before COVID were still working. And that means that over 50% of the stocks on the New York Stock Exchange are still trading below the 200-day moving average. That's where I think the opportunity is, because that was representative of people thinking the economy would fall back off again. This is showing you how unique it is. So the white line here is the percent above for the S&P above the 200-day moving average. So currently the white line says the S&P is 10.24% above the 200-day moving average, while this is that percentage of names in the New York Stock Exchange composite, which is above the 200-day. So you're gonna get up here based on history, which means at some point when we get to about 80% of the names above the 200-day moving average, that's when you can start to look for a change in the market. We're not there yet, so I think new all-time highs are not only coming, but I think there's more legs behind it just because the average stock is still not up there. This is the reason why, and this is the justification in my mind. 10-year yields down here. The other two lines are global earnings revisions and new orders for the ISM. So the leading categories of what should be happening in driving rates higher has not happened in the US. US rates are giving people the ability to believe. It's giving quants the input point to not turn bullish on things. But what's starting to happen is we have a lot of things which are saying that it's 10-year rates which are going to start to move higher. Here's 5-year break-evens and tips, which are continuing to move higher. So you've got a divergence there. These are all going to be divergences using a bunch of asset classes and sectors. Cyclicals versus defensive. After consolidating for a couple months here as the fears of COVID and the second wave set in, now we're starting to go higher here on cyclicals versus defense. There's a lot of people worried about the economy coming back down, but not on the cyclical side, not on the housing side. And the question is this a sustainable move? I think this will continue for some time. This is the inflation versus margin squeeze side. So the white line is an index by Morgan Stanley, which takes the groups benefiting from higher inflation versus ones that have margin issues. So the white line hung in there during this consolidation after the rally. It suggests that 10-year yields are going to start to move higher, and more importantly, that the economy is stronger. This is a reflation index that Morgan Stanley does relative to the S&P. It's the white line, also saying that this is going higher. You're obviously seeing this move now in rates, but I would say that one of the reasons that this continues or started is if you look back here, what has really shifted now is that earnings have come out on companies. The data's come out for August, and all of a sudden where people were worried about what was happening in July, the economic data remained strong, the earnings were good, and so now we're getting a resumption of what started in April, which is normal for this. I think the reality for all the growth versus value players that continue to argue that growth will continue to work, they should be careful of what's happening, because I do think there's a lot of secular changes that are happening. I'm happy to get on the phone with anyone who wants to discuss it, but I do think today's value names, some of those are going to be tomorrow's growers or this year's growers. These are all the secular things, and I'd be worried about expensive names that really are going to have a hard time living up to the multiples. In terms of this white line, this is financials over utilities. I've mentioned financials before. We are just starting to see it. Today's obviously a big day. You have over a 3% move in financials over utilities. For any kind of sustainable move for rates to go higher, you're going to need to see financials benefit, and that has started to occur in the last week. This is small cap over large cap. It's IWM over the S&P in terms of the white line. It's lagged in there, but you're starting to see that. I think a rotation here again would be suggestive of small caps outperforming large caps, another opportunity into the end of the year. This is value measured by the Bloomberg Pure Value, so this is stripping out other parts. It also has hung in there better, is actually, back when rates were up at 116. So the pure value side has hung in there better than what people realize. You've had a lot of other factors that have gone on, which are less about value. This is the long side of value. This is the Morgan Stanley Value Index, the long side. So the cheap names relative to the S&P, that's the white line. That has moved more closely with rates. You're seeing both of them move higher this week. That's another area to look for confirmation as we go. This is something I brought up in March, which I think is critical. This is autos, household durables, so anything related to home building, and regional banks relative to the S&P. That's the white line, and this is yields. If this is going higher, which I believe it will, I think people are underestimating the implications that are going on for the housing market and the auto market to have a sustainable move with pricing power. I think it has huge implications for the rates market, at least in turning the direction. You're seeing that in gold. Real rates has been a major story. If there is one quote unquote bubble that's going on, I think it's the focus on real rates. I do think nominal yields matter, I just don't think we're going that much higher, but I think you're being dragged up by the reflation story. This is the regional banks relative to the S&P. So we are seeing that go. Just a couple more here. This is the size chart again. Now it's showing as large cap over small cap. You can see the last 10 years we've kind of traded in a range. I think we could easily get down to here, which means we have a lot of room left on small caps over large caps. That's indicative of what the beta over quality or in this case, quality over beta showed, which is led down. So size is playing catch up. I think it's going to continue. And then this is the growth over value trade. So for all the people arguing for growth, we could not have had a better situation in terms of the dollars and the earnings that came out for July for these stay-at-home companies, which are pretty much on the growth side. On the flip side, you have the value side with a lot of companies that are beaten up and have been beaten up that did not do well from what happened with COVID. Yet somehow or another, over the last 100 days, growth versus value is unchanged. The second derivative peaked in May and has gone down. I don't think it gets enough press. The reason I think this was a weird kind of recession was the speed of it. And if this is the case, normally at this point, you will see value outperform growth. That has not occurred yet, but I still think that is a shift driven by the durable side of the economy, which is a dramatic change from a macro basis. I think that will play out. Just some other places this fits in. The white line there is this commodity index I created, which is a combination of gold, silver, lumber, crude, and copper, equal weighted. It's really meant to show a combination of inflation and growth. Obviously, gold and silver have been going up, which has been a focal point for people on the inflation side related to MMT. I'm more focused on the copper, crude, and lumber side related to the economy. But as they're all going up, that's overlaid with Asian banks. So the financials, again, are a very important part of this equation, suggesting that we should see a move in financials to go higher. This is that commodity index overlaid with tips. So it is having an impact on the tips market in terms of inflation expectations, which makes sense because of the oil impact. It just has not translated yet to nominal yield. But now that I think the sustainability of the economy is there, you'll see it. 10-year rates down here, or actually these are 5-year rates, the 5-year tips, and then the commodity index. So a lot of stuff is giving you the impact that, like the dollar was not that long ago, the next part of this trade is related to rates. This is the auto side versus value. So I'm going to end it on this. Autos, household durables, and regional banks relative to value. I would be very careful with the value side if you subscribe to the fact that we are having an urban flight situation, which is going to lead to home building. Do your homework on the household formations to see that this probably has a lot more legs with very little inventory. Same thing goes on the auto side at this point. As people move home and they need autos, the inventory situation is there, and I think you're going to have pricing power. So for the rest of the year, those are kind of the opportunities I'm seeing. A lot of stuff is happening this week in the last couple months, which is indicative of a belief in the economy being self-sustaining from this point. And I think with the election coming and more money coming behind it, we should focus on a lot of these trends and look for a shift in the marketplace that may last longer than we all think. That's it for me on this one. Sorry it went a little longer, but there was a lot of stuff to show because it had been a while. So I will see you hopefully in a few weeks.
That concludes today's webinar. Have a great afternoon.